I want to move on now to our practitioner panel, our second of two practitioner panels. Today's panel is going to be moderated by Joshua Garland. Joshua is a founding Applied Complexity Fellow here at the Santa Fe Institute. His work in that role is actually quite closely related to belief dynamics. So he's been involved for some time now in a project that has been trying to quantify utterances on Twitter as either hate or counter speech, and then looking at the strategic interactions to try and get a sense of what types of strategies are working to move conversations online. But most relevantly, I think for today's work, he's also done a fair amount of algorithmic consulting for the finance industry. And so he sort of sits in a sweet spot, I believe, of understanding the underlying belief dynamics phenomena that we've sort of gathered to talk about, but also the sort of target focal applied area of finance that so many of you come from. So with that, Joshua, let me turn it over to you to introduce our panel and get us started.
Oh, thanks, Will. Really excited today to be able to moderate this panel. We got a really great panel to kind of discuss some of the things we've been working on today and sort of tie everything together for the last 2 days. And so what I'd like to do is just spend a couple minutes and have each panelist introduce themselves. First, let's have Mani from Blueshift Asset Management. Take it away.
Hi, thanks for having me, and thanks to my fellow panelists for taking some time to share our views. Blueshift is a quantitative asset management firm. We focus on equities, and we blend high-frequency trading with statistical arbitrage. And I guess one of the things that's really interesting about this panel and an observation that we wanted to share was just how the behavior of individual stocks, in particular in response to COVID, has managed to influence factor behavior. So the particular factors that we found are most impacted are like the low volatility factor and the momentum factor, although we've seen interesting things happen with value as well. And so with my time, I just wanted to share a video that me and my colleagues made where in the context of applying and trying to introduce unique perspectives, we looked at every stock as kind of an organism, and we plotted its coordinates on a grid. It's a Cartesian grid where the x coordinate is its rank on a momentum level, and its y coordinate is the rank on its volatility. And one of the things we found that was really interesting was that the names that are associated with COVID, so the cruise lines, the airlines, those all very quickly migrated towards low momentum, high volatility deciles, or any quantile that you want to put those in. And the names associated with stay at home, so like the Amazons of the world, names that would benefit from shelter in place type policies, those all migrated to high momentum, low volatility quantiles. And the resulting, and this all happened kind of during the market bottom in March, and the resulting behavior that we saw was that factors became much more volatile, like orders of magnitude more volatile in April, May, June, and even July. Correlations between these factors, got really high. And so we just wanted to share this video from the perspective of, we think that there was a structural change, and we thought it would be an interesting perspective. So I think there's a 98% chance you're not going to see a video of my kids playing softball, and hope you enjoy it. So you can really see a migration towards those extreme quantiles. Again, the blue names are the stay-at-home names, and the red names are the COVID names. So that pink name over there is Boeing. Kind of see how that very quickly drops into the worst performer. Similarly for Amazon, goes the other direction. We didn't really see the same dichotomy in value, but we did sort of just turn the axes to kind of show. All right, thank you.
Yeah, Manny, thanks for sharing that. That was a really nice visualization. And I'd be interested, you have maybe a third of those or even less of those colored, but you see a lot of the other bubbles or a lot of the stocks or assets really trending with the blue and the red. And it'd be interesting to see, why that's the case. Is there some correlation aspect? And have you guys looked at the stocks that seem to trend with the blue or trend with the red? Are they also blue and red stocks, or is there some kind of correlation there, right?
So what we did was we went to 10 different banks and we got their top 50 names in COVID and their top 50 names in stay at home. Mm-hmm. Those were the vectors that we used to establish, those are the blue dots. And then from there, what we found was that statistically you can just, measure their beta of each of those stocks to the risk factor to examine your exposure to these things.
Fantastic. Thank you so much. So next on our panel, we have Dario from Duality Group. Could you just say a few words, please?
So hi, thank you for having me. My name is Dario, and I'm the CEO of Duality Group. It's a machine learning hedge fund that we trade stocks, futures, and ETFs. The one thing I can do to complement what Manny said, we did a study where we tried to look at the mispricing or the residual of stock valuation through time, especially post-COVID. So essentially, we think of price as some function of a bunch of accounting metrics plus some residual element that we can call mispricing. And if you can show the slide. So if you see it, especially the one to the left, and to the broad market, this is like valuation dispersion. So it's an aggregate measure of how much mispricing there is in the market, that you can see is the highest there's been. In other words, there is a lot of very cheap stock, a lot of very rich stocks, such that the aggregate measure for the mispricing is very high. To the right, instead, we have it for different sectors. So post-COVID, what we can say is that there are a lot of opportunities, a lot of mispricing, and you can see that also it's related to the fact that the hedge funds are able now to deliver vol with less leverage that they needed like last year. And I think that's very interesting, and it's a very good market for startup and any kind of relationship that is predicated on capturing mispricing.
Yeah, thank you so much. I think it's a really interesting way to look at it. I think it's a lot of way that, especially financial institutions looking at it, that post-COVID is now a really inefficient marketplace where there's a lot of opportunity for mispriced assets to be arbitraged. And I think that's a really nice visualization of looking at that. So last but not least, I'd like to introduce Jeffrey from DeepMacro. Maybe you could say a few words.
Sure. Thank you very much. First off, DeepMacro is an automated big data and machine learning platform. We find systematic investment opportunities across global macro in particular, but other asset classes. We have a research system and an advisory service that takes the output of the research system and puts it into investable portfolios. My background is as an economist. I've spent half my career on the buy side, half on the sell side. And my co-founder is a well-known data scientist who started a few of his own companies. So just a couple comments on the topic on market structure. Again, I'm an economist, so my bias is to say, obviously, that market structure is ultimately going to be reflective of, at least somehow connected to, the structure of the economy. And so that's what I'm going to discuss. Hopefully, some of the underpinnings of what Manny and Dario just spoke about. there is a strong narrative that COVID is causing the structure of the economy to be much more concentrated. Basically, kind of the Amazon effect, where because of the disease and because of government countermeasures, everything is getting very, very concentrated. And if that's happening throughout the overall economy, I think it would have several effects. I mean, first, it would obviously affect the resilience of the economy. That directly relates to the possibility of very large vol spikes in the market. Second, it would affect pricing power, which would also affect market structure. And third, it affects diversity, resilience, and I'd also say the supply of goods and services, and therefore the utility of people and the happiness of people. So my personal belief, obviously, there's an balance between order and chaos that will result in an economy that is both happy and efficient. And in that environment, markets will both be efficient and somewhat fair. And so I think that what's happening with COVID really relates to some pretty key issues. A lot of ink has been spilled on the issue of concentration, but I haven't seen a lot of evidence. So today I just wanted to discuss a few things that we're looking at. My primary source is mobile phone location data. We have a partner that supplies us with a very good set of this. I'm looking more at the consumer side of the economy than on the business side. I mean, obviously this is a very big topic. But I chose three main sectors. One would be grocery stores. Another would be fast food restaurants. And a third would be building materials. And to measure concentration, we looked at basically a very simple tried and true statistic, the Herfindahl index. This is something that even the government uses, but it's very simple to understand. You just take the market share of companies, you square that, and you add it all up. The higher the index, the more concentration there is. It's bounded at 10,000. Basically what I want to know is three things. First off, what happened with COVID? Second off, was there any change in concentration after economies reopened? And third, what are we seeing right now? We try to be at DeepMacro as real time as possible. So I wanted to go through some of the things that we've seen. So first on grocery stores, there was a significant spike in concentration in late March. It actually was later than the other sectors because basically grocery stores remained open and people had to buy food somewhere. So we were seeing a lot of concentration, but there was a very steep decline in early May. It's not quite back to the pre-COVID levels, but a lot of the increase in concentration that we saw has been undone. And I think that that's a positive. Fast food restaurants, we did see a very large increase in concentration from early March before the orders to lockdown went out. But after that, we really have returned to the starting level. And there has only been a very mild upturn in concentration recently. Building materials. Here's one that really is an outlier. We've seen a pretty large increase in concentration. The industry started out being relatively more concentrated than either grocery stores or fast food. It has declined, but it's not back to pre-COVID levels. And there's been a pretty solid increase in the recent period. We also looked at some other sectors, but I'm just going to kind of focus on all that. And first, so what does this all mean? Well, if you put the three together, I guess you could say, if you're a fast food connoisseur, you shop on your own every now and then. You don't care what type of nails or hammers you buy. This economy is evolving in a way that's pretty good for you, or at least okay. But if what you really want to do is sneak a McDonald's vanilla shake, every now and then, but wherever and whenever you want, on every block. You have a gourmet kitchen, you like to buy exotic ingredients, cook a lot, and you have a house like mine that's very old and needs a lot of tender, loving care. This is not an economy that's evolving in the right way for you. Well, I guess I'd say, more broadly, I was fairly encouraged over the summer that despite everything that hit the economy, both in terms of the disease itself and policy, which was distorting things left, right, and center, the economy seemed to be not only recovering at the macro level, but returning to more normal patterns at a structural or micro level. And I still think that that's the base case. I think we have a very resilient economy. But what I am concerned about is the most recent thing where it looks like we're seeing a double increase. I wouldn't say a double dip, it's more like a double peak in concentration levels. You know, concentration did decline as the economy reopened, but in many sectors it's increasing again. And I think what this is telling us is that how concentrated we get depends upon basically how long this lasts. The longer that COVID behavioral patterns or policy countermeasures persist, the more firms are just going to have to give up, with the other larger firms taking market share and raising the concentration in the economy. I'd also say that access to government support is quite critical here. Those who have access to fiscal and monetary support will do better, and these are inherently larger firms, not small firms. So those are just a few points from my side.
Yeah, thank you so much. That's, I mean, that's a really nice way to look at it. Appreciate that. And so I'd like to kind of shift gears a little bit and have ask you guys a few questions kind of almost directly related to the talks we heard today, starting with Villani. And so with my, you know, I started as a mathematician, primarily working in time series analysis. Actually, a lot of my dissertation work was built off of Doyne's work before he was working in finance, which may be surprising to you guys that he had a lot of interesting work before he worked in finance, but worked based on that. And what was really interesting is that I was almost primarily only working with mathematicians. So we always had kind of the set trajectory, right? Like came with a theory, we proved the theory, we worked on it, like we always had a set trajectory. And as I came to SFI and began to work with many different fields and ecologists and social scientists, I really began to see the value of cognitive diversity in exploring solution spaces, because there was no longer that linear direct vector of we start here, we're going to get here. It was right, you know, start here and then, well, what about this? What about that? And we started exploring all these different avenues of solution space. And I really realized that this is a super valuable way of analyzing problems, because getting an ecologist viewpoint on embedding theory or whatever it may be totally shifts the paradigm, totally makes me think about it in a totally different way. But conversely, it's actually very painful in a lot of circumstances, because I want to follow that linear trajectory and it's not possible, right? So the ecologist wants to pull me this way, the social scientist wants to pull me this way. And it's actually, it can be quite painful, and it can actually be this abrasive thing. And it takes a lot of work to be able to build a multidisciplinary culture where all of these different viewpoints, you kind of get the benefits of all this different cognitive diversity. And so while I really believe in what Villani's saying, because I've seen the benefits of it, what I also see is that it's quite challenging to integrate these into a single project. And so the question I have for the panel is that, what are some of the ways that you can add cognitive diversity to your own teams without destroying the working environment or the culture of your firm? Or alternatively, you can answer, should you destroy that current culture? Would that help you explore new paradigms and potentially be more successful?
Well, I can start.
Yeah, please.
You know, personally, you know, I love like working with physicists, mathematicians, and computer scientists. I'm very much in favor of cognitive diversity. The reality is, especially in a quant fund, it's very challenging to integrate like social scientists or economists. And, you know, there is a lot of cognitive, you know, diversity within the science. You know, physicists are very different than mathematicians, and mathematicians are very different than computer scientists, and even in physics, an experimental physicist is very different than the theoretical physicist. I always love to talk about the joke. Like once, you know, I was interviewing Jim Simons, and I said, who are the people who did the best in your company? And one second. And I told him, is it physicist, mathematician? We all agreed you never hired an economist. And he said the people who did the best were astronomers, because they never give in into the delusion of having the world adapt to the view they have of the world. So that you never hear an astronomer saying, if we move the Milky Way a couple of miles to the left and the moon is a little bit further away, then my model is going to work. He said most of the other scientists, they generally idealize the world to the point where it fits whatever equation are able to solve. So there is a lot of diversity, but, you know, I would stick with mathematician, computer scientists, and physicists. We have an economist, but he's from Caltech, and his math is better than some of the mathematicians we have. So it doesn't really count as an economist.
Dario, I'm not surprised to hear a physicist say this. So, you know. Yeah.
So can I weigh in?
Yes, please.
Yeah, so thanks. That's actually really interesting. I hadn't thought about astronomy in that way, so that was really cool. Like, I think that what we're finding is that the cross-disciplinary examination of these problems is really critically important. Like the example from ecology earlier this morning, you know, it's really inspirational and interesting, especially if you think about, like, we're going into a Q4 earnings season where discretionary traders have a substantial lead on the year, and they have substantial profits, and, you know, they may act to protect those profits in an economic downturn during a period that's rife with exogenous shocks. Now, as we speak today, the discretionary indices are up, 20-25%, and so, you know, we think about those aspects. It's interesting also that this is an interesting and unique time because the problems that we're solving are actually not that different from some of our colleagues in other fields. So a couple of years ago, I interviewed an ecologist, funny enough, and we were working on the same problem. We were talking about geotagging earlier. So, we're trying to figure out how we know if, somebody walked into a Starbucks and bought a cup of coffee, or if they drove by the Starbucks and, were just stopping at a red light. He was trying to figure out if a group of monkeys in Costa Rica were, migrating towards the same tree in sort of, some super highway that they developed, for their seasonal migration. And it was funny that, the problems are so vastly different, and, the applications are so interesting, but the actual work that we were doing, trying to like rationalize the vectors of movement in the context of the noise that we're facing, were quite similar. So, I think that I just bring that up because there is, funny enough, the granular details of what we're doing is what we're finding success in connecting these different fields. And, by doing that, we sort of, kind of land on a consistent language. And then, that's like a real strategy that we use to benefit from, the cognitive diversity that comes from the different viewpoints.
No, I think that's like spot on and really in line with a lot of the interactions I've had as well, is that, especially at the SFI, is that, I'm working on some kind of climate science or tracking hate speech over time. And I start talking to one of my colleagues about it, and an ecologist or a sociologist says, hey, actually, that's the exact same problem I'm working on, but it's just framed differently. And then we can take, all the tools that I have to bear as a mathematician and all the tools they have to bear as a biologist or whatever they may be, and put them together, and we actually get much more richer solution space. So that's really interesting. And like, I love this example you have with like Starbucks. That's a really clean, nice example that really illustrates that solution space kind of coming together. So maybe we can move on to one more question, unless Jeff has something he'd like to share about that.
Well, first off, in my defense, I've hired an astrophysicist.
Okay.
Second, if you can tell me how to get data scientists in their chairs before 10:30 in the morning, I'd like to know that.
No. I don't know. I mean, Will got this data scientist in a chair at 7:30, so maybe ask him. So one thing I'd like to kind of tie this back to is that, a big one of the major like themes of this entire thing is belief dynamics, and it's been touched on throughout each of the talks. And so in my view, and please correct me if I'm wrong or you have other ideas, but in my view, a lot of financial modeling, both on the technical side and the fundamental side, are actually attempts at modeling belief dynamics, even if that's not how it's normally framed. And think about value models for Nike, for example, right? Like, while some of this involves balance sheets, earnings, this kind of thing, I believe it should also incorporate modeling future beliefs about that company and the image of that company, and these kind of things. And this has notoriously been a really challenging problem due, frankly, there's just a lack of belief dynamics that are trustworthy, belief dynamic modeling that are trustworthy. But even more so, there's a very big lack of data. And there's been some attempts at this modeling future beliefs, for example, through Twitter sentiment data or influencer data, but a lot of these have failed really miserably. And so to this end, what data sources could we better use, especially on the unstructured side, that will allow you to kind of better model these belief dynamics when doing valuations?
So I guess Master.
Yeah, please.
Sure.
Okay, so one of the belief dynamics that I think dominate the hedge fund industry for hedge fund managers is, and I think there's been a decent amount of empirical evidence on this, that managers that are able to perform at a level that's kind of roughly above 10% tend to see a growth in assets in the following year. And managers that are under that level see a shrinking of assets in the following year. And so there's a obviously a lot of underlying psychology that goes into that. But just to keep this like focused on the practitioner's perspective, I mean, we think about that going into the fourth quarter with regards to how managers are positioned, and particularly things like the vast majority of like, if you look at like all the Tiger Cubs and all the discretionary traders, the correlations between their 13F filings is higher now than it has been, historically. And if you look at kind of, their holding periods, it's likely that they're continuing to hold those positions. So we try to think about, okay, so what is the most reasonable thing to do if you're in that position? You're up 20% or 15%, and there's a series of risk reducing measures that you need to take. So that that could come from the election, it could come from the weather and sort of the hurricane season, it could come from like Brexit. There's a lot of sources of distress, and another mitigating variable there that we think about is how much leverage is in the system. So we know that crowding is high just from the correlation of positions, and there's a host of other indicators that would suggest that. We know that leverage is creeping back up to pre-COVID levels. And we know that liquidity, which is another mitigating factor, is I don't know if everyone knows this, but like if you just measure touch liquidity today, it looks a lot like it did in Q4 of 2018, where we saw a massive deleveraging across funds. Meaning, you went to go buy a stock today at the bid or the offer, it does not look like a healthy market. It looks like a distress level. It certainly improved from the bottoms of March, but as far as where we look, I mean, we look like sort of the pain points of Q4 of 2018. So what happens when there is a rush for liquidity and everyone goes to trade and there's no bid? Prices move more than they normally would. And so these are all the kind of contexts that we struggle with to try to understand, and I think that those are the underlying pieces of that puzzle that that we're working with.
Yeah, absolutely.
I give an example.
Please.
An example I would use is with central banks. And Joshua, you mentioned that some things like Twitter have failed miserably, and I think it's really mostly because of we're asking the machine to do more than it really can. And in central banks, as we all know, when the Fed has a meeting or a major central bank has a meeting, the market's really focused on that. You can try to use natural language processing techniques, and some would claim that it will do a better job of knowing what's in the heart and soul of Jay Powell or Christine Lagarde than a person can, but they actually can't. But what they can do a lot better than a person can is count. A lot of things across a lot of different types of speech, across a lot of different countries, across different time periods. And so if you sort of have a model of how central banks work, or in other words, what is their model for their policy decision, then I think you can actually do an awful lot of good with it. Now, whether that qualifies as a belief or sort of a revealed preference that a machine can kind of count, I'm sort of not that tied up in the semantics, but I would agree with you that when the statement comes out, or when one of the major central bankers start to speak, we're not at the level that a machine can do it better than a human can to know what they really think or what they really believe.
Yep. No, I think that's a really fascinating point. Yeah. Dario, please.
A comment I have is that a lot of time when you use data to get insight on some of the metrics, future metrics, there is a lot of focus on forecasting what is going to be the total debt, what's going to be the operating income, what is going to be the, I don't know, revenues of a company. And you can use Twitter, you can use whatever you want. The issue is that valuation of a stock, you can think of it as some weighted sum of all the accounting metrics with coefficient that change over time. That's the narrative. So, like in 2002, when there was a crisis of accounting practices, total debt was very punished. In 2011, if you had a lot of debt, like people didn't care. So it's not just what is the metric that you can have a view on, you can gain insight from a bunch of data. It's what's the weight the market is assigning to different accounting metrics, and that changes over time. And you can have the right call on revenues, but the market is putting less weight on revenues and the stock becomes cheaper or richer, and the mispricing can take you out anyway. So all this focus on trying to forecast the state of the world, it's not just that. It's that weighted by what the market is assigning, like as contribution to a market cap valuation. This is at least on the valuation side. The rest is a statistical relationship. It's a completely different game. So, like, you know, I always give another example that if people were told, like, we were able to poll everybody and we can forecast the election, that doesn't mean you can forecast what's going to happen to asset prices. Like a lot of people who would have forecast Trump election, Trump winning, they thought the market would go down. So it's really the interplay between accounting metric, like they drive the valuation weighted by that whatever is the coefficient, that very much changes over time.
No, I think these are all very fascinating views, and it really, you know, sort of echoes a lot of things that I've been thinking about, and especially, you know, what, you know, Jeffrey and Dario are talking about with machine learning models only being as good as the models, and really kind of focusing on what they're good at, as opposed to what we want them to be good at, right? So NLP, for example, machine learning, they're really, really good at finding patterns. They're really, really good at counting instances. They're less good at understanding the underlying impacts of what the Fed has to say and what that means, especially if it's a one-off instance, right? So you need a lot of examples of things. And so I think really understanding what machine learning can do, what it can't do, and then integrating it in an assistive way is really important, especially as we go to modeling belief dynamics. I have one more quick follow-up question, I think, and then we'll pass it back to general questions about the intersection. One thing I've been thinking quite a bit about is that as we begin to integrate some of these unstructured data into the analysis and the understanding of the markets, especially things like Twitter and NLP and these kind of things, and the Fed and the stories around these and the narratives, given that we live in this culture right now of kind of a tornado of false narratives and misinformation, how do you protect yourself and your firm against falling victim to these false narratives and this misinformation when you begin to incorporate these things into your machine learning models?
I mean, going back to what I was saying, you really need to have a risk management that sees the sensitivity you have to different coefficients. You can have a very complex long-short book, and you can see that if total debt gets punished, you're going to be in a lot of trouble. Or you might have a gigantic bet that stocks are going to become richer or cheaper. So it's not different than having an options book. It's not just if you make money. It's like you have to see how much comes from gamma, how much comes from theta, how much. So how the different accounting methods contribute in a complex book, and make sure that none of the weights gets out of hand, that you cap the sensitivity to the different weights. And to me, narrative is just the market structure change, they start putting weight on one measure instead of the other. And you want to make sure that the delta, the sensitivity to each one of those measures is within reason.
That's fantastic. So it's effectively, I would call that regularizing your regression function, or hedging your portfolio, where even if you do have false narratives leaking into your belief dynamics, you kind of keep it under control by regularizing your parameter set.
Yeah.
I think that's sort of what you're saying.
If we go back to 2002, the way like the market was pricing with accounting practices crisis, how would your book look like? If we go back to 2011, where revenues were very much rewarded and that didn't matter, how would your book do? And so really decomposing like your valuation according to these different metrics, like very much like you would do with an options book. And the rest,
fantastic.
The typical risk management of volatility and, the second line of defense and all of that. But you can understand a lot if you decompose the valuation of your holdings.
Yeah, that's fantastic. So I think we're about it on time, but I want to thank the three panelists. I really enjoyed this conversation. So thank you all very much for joining us and your valuable time. And so I'll just go ahead and turn it over to Will to kind of wrap things up.